Thank you everyone for joining us today, and welcome to the next webinar in our 2016 education series, Indexed Universal Life and Actuarial Guideline 49. We will have two presenters today. Our first presenter I'm going to introduce is Gail Donato, Associate Vice President of Actuary at Nationwide. Gail has been an actuary with Nationwide for 20 years. She has worked on all varieties of life insurance product development, from term to no lapse guaranteed to indexed universal life. She has become more focused on life insurance product implementation and in-force management. As Nationwide's illustration actuary, Gail is very involved in the impact of Actuarial Guideline 49 on indexed universal life illustrations. Gail graduated summa cum laude with a Bachelor's of Science in Actuarial Science from The Ohio State University. The second presenter I'd like to introduce you to is Ramona Neal, Technical Product Director at Nationwide. Ramona has been with Nationwide for 25 years and is currently a Product Director in Life Product Development and Strategy. Ramona's experience includes 4 years in advanced markets. She also served in the Ohio Air National Guard. She has an undergraduate degree from The Ohio State University and holds her Chartered Life Underwriter and Chartered Financial Consultant designations. With that, I will turn it over. Oh, and I'm sorry, before I turn it over to our speaker, I just want to let everyone know that the presentation will be sent out to everyone who registered for this call tomorrow, and a link to the recording of this will be sent out to everyone who registered sometime next week. And if you have a question during the presentation, feel free to type it in the question box on your GoToWebinar application that's up, and we will address those questions at the end of the call. And with that, I will turn it over to our first presenter, Ramona Neal.
All right. Well, thank you so much, Kevin. Appreciate that. Good afternoon, everyone. We are so excited about your participation in today's webinar. We are, of course, going to be featuring Nationwide's IUL suite, and I'm going to give you the opportunity to hear a clear interpretation of Actuarial Guideline 49 from Nationwide's Chief Illustration Actuary. So I'm very excited about that. And before we dive in, I was just chatting with one of our Nationwide executives yesterday about an insurance company that was in the news, and I was struck by a simple statement that he made, and it was simply this: choose your carrier wisely. I was simply struck by that. I mean, if you take a look at this slide here, Nationwide's history, Nationwide is a strong and stable company. We are a Fortune 100 company, and you can see here very nice, strong history. And if you take a look, as I turn the slide here to our success, basically, if you consider Nationwide's Index UL portfolio, Nationwide is a top seller of life insurance. First, I think you'll be struck by the fact that we have a broad offering, so that we have a solution set available for you, whether it be IUL, VUL, GUL, we have a strong solution set available. Next, I think you'll notice is how competitive Nationwide is. The fact that we're actually ranked in the top 10 for all these lines, for all the lines that you see there, including linked benefit. And what's linked benefit? Well, linked benefit is Nationwide's Care Matter product. So if you're familiar with Lincoln's MoneyGuard product, in my opinion, Nationwide's Care Matter product is even better. So you've got top 10 in VUL, IUL, GUL, and even if you consider all the insurance companies in the U.S. and you're looking at total premium, then Nationwide is a top writer of total life sales as well, also ranked in the top 10. And then, of course, as you see there, Index UL, just one more comment there. We've only been in the IUL space for about 5 years, so I think it's quite remarkable and accomplished that we were able to achieve that metric there. So if you take a look, what we'll be covering on our agenda today is we're going to take a brief look at industry trends, and we're also going to talk about, and this is really important in today's environment, we're going to talk about Nationwide's commitment to policyholders. And of course, we're going to hit on our competitive IUL suites, and then I will turn it over to our illustration actuary. So, for those of you that have been in the marketplace, let's say the last 5 or 10 years, let's just sit back and take a moment to reflect. Think about how many companies are actually no longer with us. So they exited the life insurance market altogether. I even recall one example in the last 5 years or so where the exit was done rather abruptly and effective immediately, and all applications were returned. Or what about those companies that eliminated the sale of their no-lapse guarantee UL product? And again, in some cases, very abruptly, effective immediately. And then let me ask you to consider this. Even for those companies that still offer a no-lapse guarantee UL, have you ever noticed that for some of those companies, they will not allow you to convert their term product into their NLG UL? They have built a specific GUL product for term conversions. That's not the case with Nationwide. The current NLG product that's available for everyone to sell is also available for conversions. And then finally, in the last few years, we have watched public companies being acquired. Sometimes it was by foreign entities, sometimes by investors. Probably, though, the most notable recent newsworthy activity has been the companies announcing in-force rate actions. So basically increasing charges to existing policyholders. That seems to have captured a lot of attention. So again, choose your carrier wisely. So what about Nationwide? If you think about Nationwide, I just want to point out that we have a strong commitment to policyholders, and that is translated to our commitment to you. So our strong commitment to policyholders is also translated to our commitment to you. First, we are a U.S. mutual company. We are a U.S. mutual company. We do have a positive in-force rate history. And when I say positive, what do I mean? What I mean by positive in-force rate history, I mean several times Nationwide on an in-force basis actually reduced our charges. So for our existing in-force block, our policyholders, we reduced our charges several times. There is one incident where we had an increase in admin fees, but even then it was on a block that we acquired from another company. We talked about our broad portfolio offering, the fact that we still offer guarantees in all those lines. And in the marketplace, Nationwide is known as having a best-in-class LTC rider. More recently, we are also being recognized for our policy management program. So, smart strategies, powerful tools. Again, just want to reinforce, we are committed to our policyholders, translated into we are committed to serving you. And if you think about policy management, what does that mean anyway? Basically, after the policy is issued, we are there to help support the policyholder's original objective. So, for example, if they had a guarantee, so if they had one of our products that had a guaranteed death benefit to age 100, for example, we will let them know if they're on track based on their premium pattern. If your policyholder's objective was to accumulate cash, so accumulate cash value to supplement retirement income, well, then we're there to help them manage the income stream compared to their initial illustration that was submitted with the application. How about this? Again, if they're there supplementing retirement income, if that was the objective, do you ever illustrate option 2 death benefit? So the increasing death benefit and switching to option 1 level death benefit, do you ever illustrate those? Well, this is rather important. Are you managing that? Well, with Nationwide, we will help manage that. 6 months prior to the year that the switch occurred, Nationwide will send out a notification to the policyholder asking them, do they still plan to do that? And then for LTC rider, again, known in the marketplace for that, yes, we do offer referral services to help your policyholders coordinate care. So very quickly, before I get into competitive price, just kind of want to do a table stakes or foundation review here. Nationwide offers 2 Index UL products. In blue, you see our Nationwide IUL Accumulator, and in red, you see our IUL Protector. Our IUL Accumulator meets the client objective of accumulating cash value to help supplement retirement income. That's generally the chief focus for our accumulator. Our IUL Protector can meet 2 categories of needs. The first is simply a permanent low-cost insurance policy. So focused on protection, focused on death benefit. I would even say a really great alternative to current assumption UL. In addition, to the far right here, you see that we also have the optional guaranteed rider on our IUL Protector. So you can select an extended guarantee, age 90, 95, 100, 120 for an additional fee. Now, naturally, that will cost more than our no lapse guarantee UL policy, because with the IUL, you have more opportunity for cash, but nonetheless, we do give you the flexibility. So we have 2 IUL products, Nationwide Your Life IUL Accumulator and Nationwide Your Life IUL Protector. So how competitive are the Nationwide products? How competitive is our IUL suite? So what we're looking at here on this slide is basically a pricing summary for our IUL Accumulator. And if you take a look at the color-coded chart, this is benchmarking 20 insurance companies' IUL accumulation products. So 20 products are considered here. It's based on price rank. And what we're looking at here is we're looking at from age 20 to age 50. Now, although the premiums will vary by age, so the premiums will vary by age. So, for example, if you're 30, we're assuming a $10,000 annual premium. If you're 35, we're assuming a $15,000 annual premium. But anyway, the premiums will vary by age, but the scenarios are the same, which is minimum non-MEC, maximum funding, and the purpose is to accumulate cash to distribute income. And here, when you press calculate across the board from age 20 to age 50, you see consistently that Nationwide's Your Life IUL Accumulator product is ranked #1. I say this almost tongue-in-cheek, but if I were with you in person, I feel like I could just drop the microphone and walk off stage at this point. Consistently across the board ranked #1. You do see in the best tobacco classes we are not. But this is an extraordinary story. You'll also see that we did select a strategy that includes our multiplier factor. But again, Nationwide Your Life IUL Accumulator across the board, very competitively priced. So let's go ahead and take a look at a specific example. So a male age 50 preferred, paying premiums to age 65, again, minimum face amount, starting with option 2, switching to option 1. $30,000 premium, taking income age 66 for 20 years, press calculate, and Nationwide is #1 on income stream. I will add this product does have a 2-year rolling target. So this is simply an example, putting the proof from the ranking chart we just took a look at. So now let's go ahead and take a look at our IUL Protector pricing summary. And what we're looking at here, again, look at the color-coded chart. We're looking at 23 products, and we're looking at, if you notice the color-coded chart is broken into 2 sections. The first section, full pay, is level pay premiums, and level pay is paying for the life of the contract to age 120. And then we also have single payer, just a one-time premium payment. And then you press calculate, and you solve for $1 of cash value at maturity for $1 million of death benefit at these various ages. And again, quite a remarkable story. If you look at the full pay or level pay scenarios from age 20 to age 65, again, Nationwide consistently ranked #1 and #2 from a pricing perspective, again, consistently, with the exception of some of the smoker classes. And for the single pay, so just the one-time premium payment, if you take a look there, still extraordinary competitive pricing story, 23 products, and Nationwide's in the top third across the board. So let's go ahead and take a look at an example. In this case, we are looking at a female age 55, preferred class, paying that premium to age 120, solving for $1 of cash value. At the 6% return, press calculate. Nationwide is #1 on price. Now, take a look at the cash surrender values. Isn't it quite impressive that with the lowest premium that Nationwide is able to accomplish that cash value? This product also has the rolling target premium. You will notice that even though I said 6%, there are a few companies in there. I've included their current assumption product that have a rate of return around 5% or 5.5%. So if I'm including their current assumption product, I'm including the rate that they offer. But I did say at the outset that our IUL Protector product, great price, great alternative to current assumption UL, plus we have that rolling target premium with that really rich, healthy cash value for your clients. So just want to hit a couple more slides and then we'll get to our keynote speaker. And that is just asking you to consider the value of a couple of points here. And for those of you that have been following the market the last few months, certainly I think we'd all be in agreement that we recognize that the markets have been volatile. So volatile markets. So then I'm asking you to please consider the value of monthly averaging or of dollar cost averaging. So with Nationwide, Nationwide offers monthly averaging strategies. So we also offer annual point-to-point, but we do offer monthly averaging. Plus, we have an automated dollar cost averaging program. So consider this scenario. You've got a husband and wife. They're in your office. You take the application on both of them. Let's just assume for a moment the wife's underwriting took a little bit longer and her policy was issued 1 month later. So the husband's policy was issued in September. The wife's policy was issued in October. Then you fast forward 1 year. And let's assume that you selected the annual point-to-point strategy, and we know by definition, annual point-to-point, by definition, is measuring exclusively 2 points in time. Fast forward 1 year, the husband's actual crediting return was 12%, and the wife's crediting return was 0. Now, that might be an uncomfortable conversation for you if you were questioned. And so that's simply why I'm asking you to consider. So we do offer the annual point-to-point, but sometimes clients also like the opportunity to allocate some or all of their premium to the monthly averaging strategy. I would also encourage you, if you're dealing with a large premium or a 1035, to consider our dollar cost averaging program. So one other consideration here, how about considering the value of a diversified allocation offering? So do you have clients with different objectives? Well, we got a wide offering that you can select from. As I mentioned, yes, we have monthly averaging. Yes, we have the annual point-to-point. And for our accumulator product highlighted below in blue, we also have an uncapped option. So uncapped option minus the 5% spread, plus we have an international option. So again, wide variety to select from that you can allocate to. And keep in mind, your clients can choose from more than one strategy to allocate to. All right, last point to consider, and I know when Nationwide, so again, we've risen in market share. We are an index UL market leader. I've just demonstrated from a pricing perspective how Nationwide is a market leader on price as well. We have talked about choosing your carrier wisely, the fact that Nationwide is responsibly priced. We have that broad portfolio offering for you. I will say when we did launch this product now 1 year ago, we got a lot of industry buzz over this particular feature that's available on some of our strategies in both products. And it's simply called our 15% multiplier. So again, if you take a look at the slide here, you'll see some of our monthly averaging strategies offer them, some not. Some of our S&P offers them, some not. Well, what is it? And basically, it is a guaranteed interest factor that is added on to whatever growth the index grew by. So if you take a look at the two at the bottom in green, so for example, if you allocated to our monthly averaging multi-index strategy and the index grew by 6%, then Nationwide would add an additional factor of 1.15, so we would credit 6.9. So again, it's very important here. It's an option. We have some strategies that have them, some that don't. If you select the strategy with the multiplier, then Nationwide guarantees this 15% factor. It is guaranteed effective year one segment maturity for the life of the policy. That's pretty huge. As you know, a number of companies out in the marketplace, some may have a multiplier that is not guaranteed. You might find persistency bonuses that are not guaranteed. Here is Nationwide saying, we have this in our strategies. If you select it, we guarantee this additional 15% crediting effective year one for the life of the contract. And if you take a look at that second example there, we will even allow it to exceed the cap rate. So if you've got a cap of 12% with a monthly averaging, in your underlying index, the average return after that year was 12%. Because we guarantee it, Nationwide has to pay it, and we would actually credit 13.8%. So as I turn it over here to our Chief Illustration Actuary, I just want to leave you with, we have a broad portfolio offering, and it's important to choose your carrier wisely. And at this point, I'm going to go ahead and turn it over to Gail Donato. She is a Vice President in our actuarial area. And could you give us a little more background, Gail?
Sure. Well, first of all, I want to say, Ramona, that I definitely share your passion about Nationwide and us being a strong company, and certainly share your passion on the product. One thing I'm guessing we don't share is that I have actually enjoyed getting into the regulations, which I'm going to tell you about next, over the past 5 years, which is usually an area that most people don't find as interesting, but it has been fun for me, believe it or not. Like they mentioned at the intro, I've been here at Nationwide for 20 years and been an actuary my entire career, worked on a variety of life products, and then recently got much more focused with Index Universal Life, the illustration actuary role that I hold, and then digging into IUL guidelines such as the one you're going to hear about today, Actuarial Guideline 49. So to get right into the background, as Nationwide shared last September, Actuarial Guideline 49, also called AG 49, was finalized by the National Association of Insurance Commissioners back last June. The NAIC received input from the American Council of Life Insurers on how to standardize the Index Universal Life illustrations to better educate potential buyers. Nationwide was a part of this IUL ACLI task force from the very beginning, and we continue to stay involved today to ensure we communicate clearly and in a timely fashion. This actuarial guideline has 4 main goals, and it was implemented in 2 phases. So the first goal is to really increase that consumer understanding of how much those interest credited rates can vary. Makes me think of the example Ramona gave a couple slides ago, where some years it can be 0, some years it can be 12, and it's an important concept. The actuarial guideline also sought to standardize the methodology for setting that max illustrated rate that you see in your illustrations. Third, they wanted to limit the spread between the crediting rate illustrated and the policy rate charged. And finally, they want to provide guidance to folks like me, your Nationwide illustration actuary. So the first change was back in September, and in a nutshell, it really just set a limitation on the max illustrated rates for Index Universal Life products. The main result was that blue rectangle you see on your screen. So now most companies' max illustrated rates fall between a range of about 7.6% to as low as 6%. Nationwide, for all our index strategies, is at 6.86% for our max illustrated rate. Before AG 49 came into effect last fall, the range was often from 6 to 11%. And so the industry, with this change, compressed those max illustrated rates. What's important to remember, though, is this is just an illustration rate. This did not have any effect on performance, nor did it have effect on what Ramona mentioned, our multiplier. So there's three main changes that are coming with AG 49 Phase 2, and those occurred earlier this month. The regulators wanted to limit the amount of leveraged loans, and I'll talk about that in a couple of slides, and we'll stress that it's not applicable to Nationwide, but it definitely will help in consumer education as well as levelizing the playing field. And then the second is the actuarial guideline now requires we illustrate the index account at the fixed account interest rate. And then finally, the AG will require companies to show the actual index performance, the highs and lows, everything in between. And then what, if you had applied today's cap, par, and floor, what those rates would have been. So I'm going to share an example of each one of these changes, and then we'll move back into a little more info on Nationwide IUL and more about our product features. So the first one I'm going to share is about our index loans and the industry's need to educate about these loans. So Nationwide was aware how these variable loans or leveraged loans can sometimes look very large. So the example you have in front of you is a case where inside the target market, we took a male 45, non-tobacco, at $1 million death benefit. We illustrated him paying $9,000 a year for 20 years, assuming a return on the index of 7.6%. With the variable loan, that means that he can stay inside the index even when he takes out that loaned amount and continue to earn 7.6% on that loan, while the loan is only being charged, in this case, 5%. So he pays in $9,000 for 20 years, receives $11,500 for 55 years. That sounds like a really great deal. And while the math is correct, again, that's because he's only being charged 5% on the loan, and the loan is earning 7.6%. The education comes in on the second row. If you took the same cell and made it into a non-leveraged loan, so you said the charge and earn rate will be the same at 7.6%, then he'd still have a healthy income, here 15 years, from age 65 through age 80, but that kind of difference may not be as obvious to customers. It certainly wasn't obvious to me personally until I dug into it. So the new AG 49 won't allow this kind of leverage loan that you see in the first row here. It'll limit that leverage to about 1% instead of the 2.6%, which is just the difference between the earned rate and the charged rate that you see here. Again, while this page is not applicable to Nationwide, it's an important positioning for some companies that will no longer be available to them. The second change that will be applicable to Nationwide was now we will illustrate the index account at the fixed account interest rate. So with this change, we were then decided to go ahead and move those guaranteed projections on your illustration to a separate page. So now on your non-guaranteed page in your illustration, we show one set of projections that uses the alternate interest rate, which is simply the fixed interest rate strategy, and a second set of projections on the non-guaranteed page that will show the index rate you chose up to the max permitted by AG 49. Both of these projections will utilize the non-guaranteed charges and will now show up side by side. The third and final change that came with AG 49 was in the form of two new tables. The first one I mentioned briefly, which is we're going to show the actual index performance, the highs and the lows and everything in between, And then next to it, we'll show what the product provides in terms of its cap, par, floor, and how that offers some protection in terms of those index movements. And then there's an additional small table that was added to the narrative summary. It shows the minimum and maximum look-back rates for all of the 25-year periods underlying that benchmark index, which that benchmark index is simply how we calculate that max illustrated rate. So Nationwide went ahead, even though these changes weren't due until March, we went ahead and we were proactive. We illustrated these changes starting in February to really help you guys get ahead of the curve, not have a transition period, and that's a trend we wish to continue. We want to remain an active participant with all the IUL changes that may be coming out through the industry. And to that effect, we have kept up to date and are still very active. So for example, just a few days ago, the NAIC released additional AG 49 changes. We thought we were done, but we are not. Nationwide helps serve on an industry group to provide comments to those. And while none of these changes will impact our current IUL suite, it's important we stay aware of them as we look to be in IUL for a very long time. So these are the three main changes that are coming. The new regulation will allow a second benchmark, again, that max illustrated rate, if in the same product one index has a charge and another does not. Second, the regulator said if we do allow that second benchmark, that new benchmark must pass the illustration actuary test. They felt that was important to, as they put it, avoid games. And then third, the regulator said there's going to be a limit to that alternate rate illustrated, so that companies can't just artificially raise their fixed account rate only to try to improve illustrations. Again, none of these changes will impact Nationwide's current IUL suite, but it's important we keep up with those so that we can remain in compliance and remain very proactive with you all and our products. Nationwide remains committed to this IUL market, and like I said earlier, I've grown to love this kind of stuff. I'm going to help our company communicate clearly and proactively as early as possible. But for now, I'm going to turn it back over to Ramona to tell you more about the IUL features and benefits.
Well, thank you. Thank you very much. So that was basically, just like I promised, a very thoughtful and clear description of the new regulations. Just want to reinforce a couple of points. So just as Gail mentioned, that if you are selecting one of our indexed interest strategies that has the multiplier factor, that it is guaranteed by Nationwide. It's guaranteed beginning year one segment maturity for the life of the contract. Gail described the fact that AG 49 limits the rate that's reflected in the illustration, and also importantly, that even if a company has a max illustrated rate, let's say of 5.5% or 6%, what's really important to know is that no matter what the illustration limitations are, the guaranteed multiplier or any returns that your client actually experiences, their actual performance is not capped. So illustrations have maximum rates, but your client's policy does not have maximum rates except for up to the cap rate. So I just kind of wanted to point that out. So why Nationwide? So again, in the current marketplace, a number of companies have been in the news. A lot of interesting things going on in our industry. But in the current marketplace, consider doing business with Nationwide. Our mutual heritage, our commitment to policyholders, which is reflected in our policy management program. So we're not just there to do business with you at point of sale. We're there to support you the whole walk through, including after the policy is issued. And then, of course, you know that we're a market leader in all the various lines that we talked about. And for IUL to have that competitive price portfolio, whether your client solution is accumulation to supplement retirement income, whether it's simply a straight low-cost protection, or even if you want a guarantee. So even though we know a lot of companies shy away from guarantees, they don't offer them anymore. At Nationwide, yes, you can still get a guarantee. And then, of course, we have the best-in-class long-term care rider that we're known for in the marketplace. So again, I'll end with that conversation I had with that executive yesterday. There was some breaking news with other companies, and basically really struck me, and I'll leave it with you, and that is choose your carrier wisely. It's not just price, it's a big picture. Choose your carrier wisely. Look at it from a perspective of the servicing that occurs after policy issue, the features that are offered like a long-term care rider, and then also the competitive portfolio. So at this point, we'll go ahead and open it up for questions. I already have received some, so I'm getting ready to address those here. And this last slide that you're looking at here, when we send this presentation to you tomorrow, I talked in the beginning about Nationwide's positive in-force rate history, the fact that we have reduced rates on in-force policyholders. So you want to see the actual history? We included it in the deck for you. If you want to look at the actual average returns for our accumulator and protector, we will include those as well. So Kevin, are these the only questions we have here? So we'll go ahead and get started. So this first question here is, what is Nationwide's cap rate history? So I mentioned early on that we've been in the marketplace for 5 years. We'll end this year out. It'll be our 6th year. So a fairly new player in the marketplace, and yet still a top 10 market leader. And in that 5 years, 5+ years, Nationwide has never reduced our cap rate. It's not to say that it couldn't happen. There are certain market conditions that can increase the likelihood of a company to reduce the cap rate. One of those are volatile markets like we've been experiencing. And another one is low interest rate environments like we have been experiencing. I've been tracking it, and I've seen about 7 companies in the last 4.5 months or so that have been reducing cap rates. So it is possible. But to answer the question directly, since Nationwide has entered the IUL space, we have never reduced our cap rate. The second question was a little connected to our multiplier. And the question specifically says, when you illustrate 6%, aren't you really illustrating 6.9 because you have the multiplier? That's the question. And basically, if you could find that slide, Nationwide, we do have the multiplier, and it is guaranteed as we described. So it's 6 times the 1.15 factor. That would be 6.9 in the real world from a policyholder perspective. And doesn't that mean that's what we're illustrating? Well, actually, that's not correct. Nationwide has a maximum illustrated cap rate. So basically what Gail just described, the fact that we have a maximum cap rate of 6.86. So that means if you select a strategy with Nationwide's multiplier, then the maximum rate that Nationwide can illustrate is 6.86. So we're not illustrating 6.9, we're illustrating 6.86. But let me point this out to you. Sorry, it took me a while to find that. So again, if you're illustrating Nationwide with a strategy that has a multiplier, and you illustrate 6, the question is, aren't you really illustrating 6.9? The direct answer is no, we're illustrating 6.86 because 6.86 is our max illustrated rate. Now, the next question there is, well, why, you're getting that extra 0.86, that almost the extra 90 basis points. But please consider this really, really important. Our multiplier is guaranteed. Guaranteed effective year 1 for the life of the contract. So if anyone would question if that's fair, I would say, well, yeah, it's fair. It's guaranteed. And if you think about it, we're not even truly fairly illustrating it because we're guaranteeing 6.9. But when Gail Donato did her analysis, she felt that based on the formulas, that 6.86 is the max rate, and she took a more, in my opinion, conservative position. and is saying we will not illustrate above 6.86. So let's say Nationwide were to drop our cap rate moving forward, and let's say 5.8 is the max illustrated rate. Then that would mean, irregardless of the multiplier, 5.8 would be the maximum rate that Nationwide would illustrate. So I hope I'm leaving everyone with the fact that anything that Nationwide is illustrating as it relates to the multiplier, one, it's guaranteed, and two, it will not exceed our maximum illustrated rate. The next question I got was, what is included in that monthly averaging multi-index? So what actually, you know, we're talking about monthly averaging, it's a multi-index. Well, what are you tracking? Really good question. We are tracking the Dow Jones, the NASDAQ 100, and the S&P 500. And so what occurs is you're tracking all three of those indexes, and whichever of those performs the best, we'll give it a weighting of 50%, 30% second best, and 20% third best. So you're tracking all three, and then at the end of the year, when you're tracking them, you're recording what occurred from a monthly basis to get an average. Then you average those returns out by the end of the year with the weighting that I described to get that monthly averaging crediting. So that was a good question. Next question, if you have a lump sum payment and it's paid into the multi-index monthly averaging, how does the crediting work? So if you have a lump sum payment that's paid in the multi-index monthly averaging, how does the crediting work? So let's say you have a $100,000 1035 that comes in January. So then what occurs is Nationwide is going to record what those three indexes have done every month on the 15th of the month. So the 100 grand came in on January. On the 15th of January, Nationwide's going to go see what did the Dow Jones do on January 15th, the NASDAQ 100, and the S&P 500 on the 15th of January. We will record what it did on the 15th of February, on the 15th of March. So the 15th of every month we'll record what it did. Then we'll determine which of those was the first best performing, which of those was the second best performing, and the third best. And then based on that order, we'll give the best performing a 50% weighting, the second best 30%, and the third best 20%. And then we'll average all those returns for the year. So from the 15th of the month, we'll average all those returns for the year. And that includes anything above the cap rate and below the floor. We'll average the returns, divide by 12, and then subject it to the cap rate that you see there. So that's how we do the crediting. So it would be still subject to the 0% floor and subject to our cap rate. The next question is there a minimum cap? And for all of our strategies, except for our uncapped strategies. So if you consider all the strategies that we were looking at right here, so the multi-index, the S&P, the international strategy, our minimum guaranteed cap rate is 3% on all of our strategies except for the uncapped strategy. For the uncapped strategy, we do not have a minimum guaranteed cap. The last question I have here, and we've got a few more here, does the multiplier affect the premium? So again, if you're selecting a strategy, the multiplier doesn't impact the premium per se, it just impacts the performance. So for example, if you earn 6% on a strategy that did not have the multiplier at segment maturity, then Nationwide would just credit 6. If you had the multiplier, we would credit the 6.86. Now the only footnote I would say to that is, if you were in our IUL Protector product and you were solving for premium in a strategy with the multiplier versus without the multiplier, you would get a slightly different premium because with the multiplier, you would get the additional 86 basis points that's being reflected. So I don't want to say from a client perspective it impacts the premium, but from an illustration perspective, if you're choosing a strategy with a multiplier versus without, you will notice a difference in the premium. So I hope that answers that question. And we've got a few more coming here, so I really appreciate the questions. I'll also add that, again, you will get this presentation tomorrow electronically. And at this point, I'm going to go ahead and turn it over to our illustration actuary. We've got a few more questions here. So as Gail is reviewing that, we'll turn that over to her.
Yeah. So the first question is, are regulatory changes anticipated with regard to the bonus interest credits? So while not applicable to Nationwide today, there has been continued talk about those bonus interest credited. And right now, I would say there's no changes that I would expect to happen this summer. So those next round of changes I talked about are really more about companies that have two benchmarks because they have one index with a charge and one without. It's been brought up several times about the bonus, but on the most recent NAIC call, on the ACLI working group, and on some other documentation I've looked at, it hasn't been brought up in a while. So my guess is there'll be no changes for, the next 6 to 9 months. It's tough to say beyond that because this issue has come up multiple times, and it seems like the regulators continue to look at AG 49. So I wouldn't say it's a dead issue in my opinion, but short term, next 6-ish months, probably no changes. So the next question was what will happen if the multiplier, the result of the index, is above the cap? So that came up on one of Ramona's slides as it's a great question. I believe it was around slide 18, that we would allow it to go above the cap in real life. And then the final question I'm seeing is the crediting compound interest? And my answer is yes. The crediting is compound interest, so if you get 7% return next year, then you're going to have a bigger accumulated value, and then you'll get interest on that interest you earned the prior year. And that would actually be true for all of our universal life products, that it is a compound interest.
All right. So we've had a nice slew of questions there. You'll get a copy of the presentation tomorrow. I want to thank Gail Donato, our illustration actuary. That was wonderful. I also want to thank the participants for putting your confidence in Nationwide and recognizing the global picture of the company that you do business with, the services they offer, and the competitive portfolio. So thank you again for participating. We value your business.
Thank you.